Welcome everyone to Rethinking Retirement, Understanding Taxes, Income, and Healthcare in Retirement. I'm really excited because obviously there's a lot of changes that have happened here recently, but I want to talk about the specific things that people, especially in those what I call critical 15 years of retirement. That's the 10 years before you retire up until 5 years after you retire. Very important that you are understanding the risks involved in those aspects of retirement, but then that you're prepared and that you're planning for it. So with that, I'm going to go ahead and get started. Just a quick disclosure, anything we discuss today is not meant to be taken as specific tax, financial, or legal advice. It's meant to be general and informational in nature. If you have more questions, I'll give you an opportunity at the end to follow up and we can have some time to chat one-on-one. But just so you know, anything we discuss in the presentation is meant to be educational in nature. So who is this class for? Well, if you're a baby boomer or you're in that stage of life where you're maybe 10, 15 years out from retirement and you want education on how to build a steady stream of income in retirement, ways to reduce taxes in retirement, understand healthcare and the landscape of healthcare in retirement, and then also develop peace of mind that comes from having a comprehensive financial plan. If that sounds like you, then you're in the right place. And I'm excited for you to be here. So, who am I? Well, I'm a former rocket scientist. I've worked at companies like Raytheon, SpaceX, Lockheed. I'm creator of the Rethinking Your Retirement Roadmap, and that allowed my wife and I to pay off over $100,000 of college student loan debt, save up an emergency fund of 1 year, give over the last few years of $150,000 in charitable donations, and then lastly pay off our mortgage. And we've actually been able to do that very fast. And so I teach a lot of classes on retirement and retirement planning, and I teach those to hundreds of other families, both online and in person here in my local area. So again, excited for y'all to be here. Just want to share a little bit about my story so you have a little bit of context of who I am. My story into the financial services really starts with my father. And actually, there's a picture I took with him about 10, 15 years ago. We were on a cruise, took my parents on a cruise. And I was asking my dad, I said, "Dad, do you have any retirement plan or investment plan in place?" And he said, "Yeah, David, I have 5 retirement plans that I've been investing money into over the years." And I was kind of taken aback. He had never talked about financial planning or investments. And the punchline to the story is I'm one of 5 kids. And so he was really pouring his investment and his time and energy into us being the retirement plan. But unfortunately, about 10 years ago, he passed away. And so after that experience, I had to walk my mom through a lot of tough financial planning questions. And a lot of those, regarding Social Security and Medicare and all those things that come along with, baby boomers planning for retirement. I had to walk her through that, and it was really tough for me. But it was also, it kind of gave me the spark. I was working at SpaceX at the time, and it gave me the spark to help other people. And so that's one of the things that I'm doing here today, just trying to help other people plan for a graceful retirement. And so I walked my mom through a lot of those tough financial planning questions, and I wanted to help more people. And so that's when I started teaching Financial Peace University at my local church, and then other churches and community centers around the area, and really got really got set on fire to help other people. I really enjoy educating people and just giving them the wisdom that they need to do that. And I found a team of financial advisors eventually, which is the part of the firm that I'm at now, Wise Wealth, to help people really understand their financial planning and really how to prepare for a graceful retirement. And that's when I joined Wise Wealth. And just a quick synopsis of Wise Wealth. Wise Wealth's mission, the mission of our firm, is to guide families on a path that makes work optional and design a plan that empowers the freedom to give, serve, and enjoy life like never before. At Wise Wealth, we are known for education and financial education specifically, and simplicity. And we really believe that education should take someone from knowledge and information to transformation, and that's the wisdom aspect. And I always tell people, knowledge is knowing that a tomato is a fruit, but wisdom is knowing not to put it in a fruit salad. And so we also believe that by making the planning process simple, we can help people avoid confusion and build confidence. And we do this through the proprietary planning process called the Simplify Your Retirement Plan, which we'll talk about more later. So again, really excited for you to be here today, to be learning about rethinking your retirement, understanding the taxes, the income, and the healthcare aspects of retirement. And so there's a lot of different risks and concerns and challenges that come up when people are planning for retirement, especially in those last 10 years before they retire. And there's a lot of different aspects that people might be concerned about. And if that sounds like you, you might be concerned about one of these aspects. And if you'd like, you can put in the chat box what you're most concerned about. It might be longevity. It might be, outliving your money. It might be inflation. And a lot of people have been messaging me that inflation is kind of on the rise here. And another one is healthcare costs, long-term care. If any of these kind of jive with what you're concerned about, just type it in the chat box so I know kind of what to focus on more. Taxes, rising taxes are a concern that people are, I think rightfully so, worried about. Regulation, a lot of regulation, and especially with the Secure 2.0 Act, that has changed recently. A lot of regulation has come out, changing the landscape of retirement. Pension and defined benefit scarcity. That's another one that we see a lot of people moving away, a lot of companies moving away from pensions. Stock market volatility, obviously, being a big one. Traditional investment strategies, investor behavior and bias. So our own personal behavior as investors that could sabotage us sometimes. And then finally, just the overall lack of a plan. And so these are some of the big concerns, big risks that are plaguing people as they enter retirement. I'm not going to touch on all of them, but I am going to touch on quite a few of them because I think it's important for you to understand what risks are the greatest and then how to mitigate those risks. So the first one is longevity. And I just think people need to understand that, especially for couples that are, 65 today, there's a very good chance that one of you is going to live to age 92. And so when you think about a time horizon from a retirement planning perspective, a lot of people need to think from potentially 65 to 95. So almost 30 years of retirement planning. And so when you think about 30 years of horizon, you're thinking about 30 years of inflation, 30 years of medical care costs increasing, 30 years of the cost of goods increasing. So there's a lot of things that you needed to plan for when it comes to longevity from that perspective. Another big one is inflation, and especially in the areas of for consumers that are in this phase of life, medical care. I don't know if you can see on the bottom, but medical care and housing. So housing is this long one, this long yellow one. That's more the CP. There's something called CPIE, which is the consumer price index for people in those later years of life that are higher than the normal CPI. And that's in medical care. So this one here, and then also in housing. And so for good reason, a lot of times people are spending more on housing in retirement because of medical care that they need. And then also medical care is just another big one that people have issues with. And so if that sounds like you, you're not alone. Another big one is healthcare costs, just overall healthcare. There's a lot of assumptions that people make, like Medicare, is free, or that they won't have to worry about medical care. But the average retired couple, age 65, needs around $350,000, $315,000 saved after tax to cover healthcare expenses in retirement, and that does not include over-the-counter medications, dental services, or long-term care. And so a lot of aspects of retirement that a lot of people aren't assuming, or incorrectly, they're not going to be able to pay for them because they won't have the money. And so if you're thinking about the healthcare costs for a married couple, 350,000 is kind of what we're looking at, and that includes your specialty drugs, your generic brand drugs, your Medicare surcharges, so Medicare Part B and Part D, and then of course all the other aspects of medical care that comes along with that. And so as an example, I've just put together some sample annual Medicare costs for per person. That includes, Part B and supplemental plans and Part D, and prescription copays, just so people can kind of get an idea of what an annual Medicare cost per person comes out to. It's about $6,000 a year, and then you multiply that over 30 years, and that's where that number comes from. So it adds up over time. From a long-term care perspective, again, medical care is not considered long-term care, but someone turning age 65 today has almost a 70% chance of needing some type of long-term care services in their remaining years. And again, medical care is not the same as long-term care. There's a few different aspects of long-term care that and you could pay for them in certain ways. But when Medicare realizes that you can't do 2 out of the 6 of what's called activities of daily living, ADLs, then they say that this is not a Medicare or healthcare issue. This is a long-term care issue. And so it's important that you understand Medicare does not cover long-term care. The different aspects and ways to pay for long-term care might be self-funding. So people might just want to say, I want to just assume the risk. I'm not going to transfer the risk to anybody or any outside organization. I'm going to assume the risk to self-fund the money myself or ourselves. The second one is Medicaid. Now, Medicaid is not the same as Medicare. Medicaid is a government run institution and program that provides funds to help people that have basically drawn down all of their assets or the majority of their assets to pay for long term care. So, again, if you're on the Medicaid system, you have been through this process, but you have to draw down the majority of your assets to pay for these long term care issues. Um, for family and friends. Family and friends is a big concern when we're thinking about long term care. A lot of times, people, or it used to be that this is a perfect example. My father used to consider, the family and friends program as his program, and so um, unfortunately, that's just not the case these days, right? A lot of people have moved away from their family, have moved away from their friends, and they don't have that network or support system to rely on from a long term care perspective. And then the last way to pay for long-term care is obviously transferring the risk or long-term care insurance. And so that would be through some sort of traditional long-term care insurance, which would be, um, you know, um, maybe traditional premiums that you pay every month, or some sort of hybrid long-term care insurance, which is gaining in popularity because there's some less stipulations, and people are funding them through their assets, through their IRAs and other forms of funding. So there's different ways to pay for long-term care, but in general, those are some of the aspects. Another big risk that people are concerned about is taxes. And so, top federal tax rates have dramatically changed in the last few years. So, we are nowhere near the top federal tax rates that we have been in previous years. And so, when you think about taxes from a long-term perspective, right, we are historically at historic lows from a tax perspective. And so, as people start thinking about, what tax rate am I going to be in the future, I think a lot of people can agree that we might be in the coming years going into a tax rate environment that's higher than we are currently. And we already know, actually, with the Tax Cuts and Jobs Act, that the current tax rates under the TCJA are going to be increasing. And we know that at the end of 2025 and then in 2026, all the rates will have gone back up to the pre-Tax Cuts and Jobs Act rates. So that's something that we all need to be concerned about and be mindful of. The other way that taxes impact us is from a social security standpoint. So again, a lot of people might incorrectly assume that social security income is tax free. Unfortunately, that is not the case. And so there is something called provisional income that can affect the way that your social security becomes taxable. And so the way it works, I put it up on your screen for this year. The way it works is if your provisional income is if you and if I'll just talk about for a married filing jointly. If your provisional income is less than $32,000, then it's 0% taxable. If it's 32 to 44,000, then it's 50% taxable. And if it's over 44,000, then your Social Security is 85% taxable. And again, your provisional income is your adjusted gross income plus your non-taxable interest plus half of your Social Security benefit, and that is what constitutes your provisional income. So and again, it just really depends. If you're single, then there's different rates there. If you're married, then there's other rates there. So it's important that you understand kind of what your rate is, and then how it affects your overall tax environment. So hopefully that makes sense. The other aspect of taxes is going to be your Medicare. So again, a lot of people don't understand that Medicare Part B and Part D is actually subject to what's called an IRMA surcharge. And if you make over a certain threshold or over a certain income, so as an example, if you're married filing jointly in 2021, if your modified adjusted gross income was over a certain amount, then you would have a certain level of Part B or Part D premium. And every time it goes up over these thresholds, you have to pay a higher premium. Now, I just want to mention this in the way that our current tax rates are. So your federal tax rates when you pay taxes, that's a marginal tax rate. With the way it works for Medicare Part B and Part D surcharges is if you're $1 over that threshold, you pay the full upgraded IRMA surcharge. So it's important that you understand. A lot of times people will talk about, doing Roth conversions or doing other things, taking more money out of their accounts, but they might not be thinking about tripping these IRMA Part B and Part D surcharges. So it's important that you understand from a comprehensive standpoint how it affects your IRMA. Regulation. Again, I mentioned Secure Act and Secure Act 2.0 updates. There's a lot of changes, but a lot of stuff is kind of in the noise, and I just wanted to highlight some of the big top hitters that people should be paying attention to. One of them being the RMD age is now 73 beginning in this year, and then it's eventually going to phase over into 75. And now a lot of people think, oh, this is amazing. I don't have to take my RMDs until age 75. The problem with that is though, before it was just 73 or maybe 72, and so now it's going to be 75. So that gives your accounts more time to grow, which you think would be a good thing. What that means is that your required minimum distribution will be larger now, potentially because the market will have grown quite substantially by the time you turn 75. So again, is it a good thing? It might be, it might not be in your specific situation. The next one is catch-up contributions. So catch-up contributions have increased, and there's some limitations there, but in general they're increasing by a good amount there. The next big one is 529 plans. Now this was a big piece of legislation that changed a lot from a 529 perspective, because traditionally 529s, and the reason why a lot of people were concerned about putting money into a 529 for maybe their grandkids is that if you don't use it for education expenses, you have to then transfer it or figure out who to get it to next to use the funds. Now there's a provision there that you can roll it over to a Roth IRA. There are some stipulations there, like you have to have owned it for 15 years, and there's some other limitations there. But in general, this is a really good aspect to 529 now. And then, of course, Secure Act 1.0 changed the inherited IRA 10-year rule. And so if you've inherited an IRA, you can no longer stretch your distributions over your lifetime. You have to now take them over a 10-year window. This is a big piece of legislation a lot of people haven't considered, because when you're thinking about receiving as a beneficiary of an IRA, or if you're passing on your IRA when you pass away, this is a big piece of legislation that will have changed a big landscape from a tax revenue perspective in favor of the government. And then finally, the Tax Cuts and Jobs Act of 2017. I want to mention this again because this sunset provision ends in 2025. And so everybody's tax rate will go back up in 2026. So again, don't miss out on, if you're thinking about, maybe making contributions or doing Roth conversions. Now might be a better time to do that, depending on your income and your tax situation currently. So a lot of different opportunities there from a regulation standpoint. And then from a Social Security regulation standpoint, we know, because the Social Security Administration has told us, and actually in the bottom left of your screen, you'll see it says the combined OASI and DI trust funds will be able to pay all benefits in full and on time until 2034. So we know that there is some concern and some issue with Social Security revenue not being enough to meet the demand. So that's another aspect of regulation that we need to consider. Another aspect of risks planning for retirement are the stock market volatility, and we'll cover some different aspects of the stock market. But the first one is volatility. So volatility is obviously a big concern, and I want, especially if you're math minded, I want you to think about this for a second. Even if you're not math minded, you need to be aware of how this works. When people think about retirement planning and they think about their average retirement, and then they think about, the average rate of return in their retirement plan, and then their real rate of return, these are very different numbers. And I think it's important that everybody understands that the average is not the same as the real rate of return. For example, this account value that started with $1,000 and over 10 years had plus 10%, minus 10%, plus 10%, minus 10%. It did that back and forth for 10 years. The average rate of return for this portfolio is 0%. But the real rate of return, meaning what you actually got in your pocket, was less. It was actually a negative 4.9%. So it is important that when you think about retirement planning, a lot of times people will tell me, well, I'll average in the market 6. I'll pick a portfolio that will average 6 or 7 in the market, and then I'll pull out 3% in the market, and I should be okay. But remember that the average, and especially when you're taking distributions, the average is not the same as the real rate of return anytime there's a downward slope. Okay, so it's important for you to understand that. The other biggest risk that I see from a stock market perspective is the sequence of returns. And the reason I'm talking about this is because this directly affects a lot of people's income in retirement. A lot of people are thinking about using the stock market to generate income in retirement. And it's not a bad plan. It's just that you need to understand the risks of using the stock market to generate income in retirement. So when I mentioned sequence of returns, when people are saving for retirement before they retire, the sequence of returns does not matter when they get to retirement. From the time they've been in the accumulation phase, meaning they put money in every month, the sequence that their returns came in hasn't mattered because they're not taking money out. So before retirement, the average return matters more than the sequence that it comes in. And as an example, I put up here three different portfolios. So portfolio A, B, and C. They all have the same returns, but in completely different orders. Portfolio A has a really strong first year, and portfolio C has a really negative first year. But as you can see, because because they all average and they're in the accumulation phase, they all end up with the same amount because they're not taking any money out of their retirement accounts. Now, the story is very different when they start taking money out of their retirement accounts. So sequence of returns matters way more than the average return when you're withdrawing money from your account. Perfect example would be if you were in the crash of 2008, 2009, you might have had to have gone back to work in order to recoup some of your losses if you had to take money out of your retirement accounts during those years. So the problem here is if you end up in a bad sequence, meaning when you retire, if the next couple of years are pretty bad, you might not have as much money, or you might have to adjust substantially the amount of income you can pull out of your retirement account. Perfect example here is the portfolio A. It starts off with really good return years. Portfolio C has really bad first couple of years. And as you can see, they hit zero pretty quickly. So it's important that you understand that your sequence of returns will be different from everyone else. So your neighbor might say, yeah, we had a really good sequence of returns, put all of your money in the market and you should be fine. And that's because their sequence of returns was different. And your other neighbor might say, don't put any money in the market because you'll have a bad sequence of returns. And they might be true. Both of those will have true statements for them, but it's different for you. And so it's really important to understand kind of the market environment you're in and then the risk you're taking by relying on the market to provide the income for you. The next aspect here is the stock market. I want you to understand that breaking even in the stock market does not mean that you've hit the amount of money that you had before you started. So as an example, if you lost 20% of your portfolio, if you gain 20% back, it doesn't actually mean that you've hit the exact same number. It takes a higher percentage to overcome a loss. So if someone says, yeah, my portfolio went down 20%, but then it bounced back up 20%, so I should be fine. That from a numbers perspective, you think it makes sense, but from a reality perspective, the real rates of return that you get are different. And so it's important you understand it takes a larger gain to overcome a loss. So that's when I talk about breaking even. And then the last risk here I want to talk about is from the stock market perspective is the return perspective. So many people, and I've circled it here, the average investor here, and this is a study done by JP Morgan Chase, the average investor only gets about 2.9% return in the market, and which is kind of surprising, but a lot of this comes down to investor behavior. I actually was on the phone this morning and someone mentioned that they sell when things get bad and then they buy when things get better, and it's really hard to time the market. And so average investor behavior is not the way you want to go. It's really important you have someone that can help you from an accountability perspective, stick to your goals and think with a long-term perspective. So, and when I talk about long-term perspective, remember, I'm talking about potentially from 65 to 95. So you might be thinking about 30 years potentially for your retirement. So when we talk about the different phases of investing, it's important for you to understand, and this is why the average investor might not hit their mark, is because they might be investing in the wrong phase. And so there's three different phases of investing, and I call this the three different phases of investing. But people sometimes are investing not according to their phase. They might be investing according to some risk tolerance questionnaire or something they saw online. But it's important you understand which phase of investing you're in so that you can invest appropriately. So if you're in the accumulation phase, that's the first phase of first phase of investing. And that's for people that are, more than 10 years out from retirement. Most of the people that are on this webinar right now are probably within that 10 years of retirement. So they're what I call in the preservation phase. And then finally, that last phase is from retirement on. That's in the distribution phase. That's when that money that you've saved and earned needs to now pay you back. And there's something that I call the critical 15. And this is the 15 years around retirement. It's the 10 years before you retire and then the 5 years after. And again, a lot of risks come into play, but especially the sequence of returns risk comes into play here as well. But we believe that the 10 years prior to retirement up to the first 5 years in retirement are the most critical years for your retirement plan. This is the time when you cannot afford to make a mistake. So remember the critical 15. And if that sounds like you, then you don't want to be making one of these mistakes. So again, we've talked about a lot of the concerns, risks, and challenges from longevity to inflation to stock market volatility to healthcare costs and long-term care. But the biggest risk that I see is that people do not have a plan. It's a lack of a plan. They don't have the principles to develop a holistic and comprehensive retirement plan. So I'm going to give you the tools and the resources to build a financial and a comprehensive retirement plan and things to think about as you're building your own. The first one here is the principles. Everybody should be focused on principles when they develop their retirement plan. And the 5 principles that we utilize at our firm are: no investment decisions outside the context of a plan. The plan determines the products. Don't let your portfolio take a hit, and HIT stands for healthcare, income, and taxes. That's what we're talking about today. And then protect your income, grow the rest. And then finally, financial peace comes from having a plan. And I really believe that a lot of people are concerned unnecessarily, but it's mainly because they don't have a plan in place. So what are the elements of a plan? Well, I'm glad you asked. I think the core elements of a plan, especially a good comprehensive plan, is that they are written down, that they include these 5 areas of retirement planning. So your income, your investments, your healthcare, your taxes, and your estate or your legacy plan. I think it involves a paradigm shift from your return on investment ROI to reliability of income. Most people in retirement don't want to be focused on what the market's doing from day to day. They just want to know that the paycheck's coming in every month. It's also a good element of a financial and a retirement plan is that it's phase based, meaning the 3 phases of retirement. We talked about the accumulation, the preservation, and the distribution phase, so that at any moment you know which phase you're in and how you should be invested and have a plan in place for that. And finally, it should address all the risks. It should address the income risk, the inflation risk, the healthcare risk. You should have a strategy for all of these aspects. And it really should be principles based. We talk about the 5 principles of retirement planning. And then finally, it should have a 3-bucket approach. And this is the 3-bucket approach that we use with our current clients. And it's very simple. It's very easy to understand. The first one is the liquid bucket. The liquid bucket is money is going to be used for any known purchases or expenses within the next 5 years. So if you know that you have an expense or purchase in the next 5 years, that's where you're going to keep it safe and preserved in some sort of maybe a checking account or savings account that it's going to be ready to go. The second one is the income bucket, and this is the amount of assets that it's going to require to produce the desired retirement income for life that you and your family need. It's very simple to calculate. You determine your income need, you determine your living expenses and your lifestyle expenses, and then you subtract your guaranteed income sources from those expenses. So if you have a pension coming in or Social Security or annuities coming in, that's what you're going to subtract from your living and lifestyle expenses. And then you solve for the gap. You determine what is the least amount of assets needed to guarantee the level of income that I want in retirement. And for all intents and purposes, this money is not liquid, and it should be protected to make sure that your income can be coming in every month. So that's the liquid bucket. And for many people, Social Security is one of the largest aspects of their income bucket. Many people are relying on Social Security to beef up their income in retirement. So I want to touch briefly on Social Security and some of the strategies that people use. But in general, there's 3 different times that people generally file for Social Security. It's early, so at age 62, at their full retirement age, which varies depending on when you're born, and then late, which would be age 70. There's a lot of different ways that you can file for Social Security, but in general, Social Security is one of the largest retirement assets that most people have. And the key way to increase your Social Security benefit is just to delay it as long as possible, especially if you're still working. So a lot of times people will ask me, hey, David, how can I maximize Social Security? If maximization of Social Security is the only thing you're asking about, then just wait until age 70. But a lot of times people are not considering how Social Security, and from a taxation standpoint, will affect the rest of their income. And I'll talk more about that from a timeline perspective. But a lot of people are just making the Social Security decision outside the context of a plan, which I don't think is the way to go. So the decision on when to take Social Security should really be based on your plans and your goals. Do not make the decision to take Social Security outside the context of a full financial plan. Also, from an income bucket, there's a lot of different tax optimization strategies, and I don't have time to go through every single one of those, but it might be evaluating the differences between a Roth IRA or a Roth 401k. It might be considering doing Roth conversions, especially while we're in a low tax rate environment. It also might be considering timing of your tax deferred withdrawals. It could be that the donor advised fund, which is especially useful for people that are charitably inclined, that are already giving to maybe churches or to nonprofits or to other things that are important to their life, as long as they're a 501c3. This is a huge opportunity that I see a lot of people missing it on. Another one might be tax loss harvesting, harvesting losses in their investment accounts. Another one might be qualified charitable distributions or QCDs. Again, some legislation changed with the Secure Act that had some positive outcomes for QCDs. This is a way for people from their IRA to be more generous in their giving. So it's called qualified charitable distributions. Other aspects of life insurance, or sorry, tax optimization strategies might be life insurance. So some sort of life insurance to create tax-free income for their, tax-free benefit for their beneficiaries. Health savings accounts might be another one, and then also making sure that they're optimizing their tax exposure because of Social Security taxation benefits, and then IRMA, or their Medicare surcharges. So again, there's a lot of different aspects there from a tax optimization perspective, but really everyone should have a good, solid, forward-looking tax planning strategy as part of their overall plan. And that's another big aspect of the income bucket, especially. The second, another aspect of the income bucket I want to talk about is withdrawal strategies. Now, again, a lot of people ask me like, hey, when should I take money out of my Social Security, or when should I start taking money out of my taxable accounts or my tax-free accounts? And I just put up some of the things you might need to be considering. So consider, when will you turn 62? When will you turn 65? When will you get on Medicare, as an example? When will you apply for Social Security? When will you start taking money out of your tax deferred accounts? Or will you be forced to take it out when you hit your required minimum distribution age? And a lot of people don't realize that when you turn, at least now, when you turn 73, you are forced to take money out of your retirement accounts, whether you need it or not. The government says it's a required minimum distribution that you must take out of your account. There's a big penalty if you don't. So it's important to understand those laws as well. So a lot of people have questions about like the timing. When should I take my money out of my pension? Should I do a lump sum? Should I take money out of my taxable accounts or my tax-free accounts? When should I take my Social Security? All of those questions should be answered in the context of a full financial plan. So the questions about when will you draw down assets and in what order? Do you have a forward-looking tax-efficient withdrawal plan? And then how will your income affect your overall Social Security benefit and then your Medicare premiums? Those are all questions that need to be answered inside of your income bucket. And then last bucket here is the growth bucket. So for the growth bucket, it's very straightforward, but you really need to just determine the rate of return for your need and for your goal, and then take the least amount of risk for the desired result. Once you choose your asset allocation and diversified portfolio, you'll have those future income needs and purchases set aside inside of your growth bucket. And this can really help offset inflation and taxes and healthcare expenses as they increase as well in retirement. And there's two keys used that we talk about in the stock market. And one of them is time. And then the second one is discipline. And when you have a disciplined approach to being a long-term investor from a growth perspective, we see more people succeed than not. So those are the three buckets, we call a three-bucket approach to retirement planning. So are you excited? Are you overwhelmed by what we're talking about? Well, you don't have to be overwhelmed, and there are people there to help. And so if you're excited or you're worried or concerned or overwhelmed, I would encourage you to book a call. There'll be a screen pop up on your screen, and you're able to book a call with me directly. Who should book a call? Well, if you're a baby boomer and you're in the critical 15, so you're in those last 10 years leading up to retirement, or maybe you've just retired and you're in those first few years of retirement, and you want education and advice on how to build a steady stream of income in retirement, maybe that's you. If you want to figure out if there's ways to reduce the taxes in your retirement accounts or on the cash flow, maybe you should book a call then. Maybe you want to understand the healthcare landscape in retirement and how it applies to you. Or maybe you just want to develop the peace of mind that comes from having a comprehensive plan. If that sounds like you, then I would encourage you to book a call. And what you'll get on this call is we'll go over your current financial situation. We'll discuss your values, your goals, where you want to be financially from a retirement perspective. We'll look at the problems you're facing. So it might be any one of those that we talked about today. And we'll discuss what you need to do to overcome them. And then we'll see if it makes sense for you to implement a Simplify Your Retirement Plan. And the Simplify Your Retirement Plan really has a holistic approach from an income growth, tax, insurance, and legacy or estate planning perspective. We do this with anyone that comes through to become a client. It's a very comprehensive approach that we take to make sure that they have a plan in all of these key aspects of their retirement plan. And lastly, I just want to talk about our name, Wise Wealth. Wise Wealth is built is based on a scripture from Proverbs 24. It says, "By wisdom is a house built, and by knowledge and understanding, its rooms are filled with precious and pleasant riches." So the principle there is first wisdom. First, you need to understand. You need to have the knowledge and the wisdom to do something, and then you can develop the wealth that comes along with that. Wise Wealth is an independent firm. That means we're not owned by any bank or brokerage product, so we can look at anything that might be helpful to you. We are full service. So we do both insurance, tax, investment planning. We do it all. We do it all under one roof. We are fiduciaries. That means that we do what's in the best interest of our clients first. And finally, our mission. And again, I mentioned this in the beginning, but the mission of Wise Wealth is to guide families on a path that makes work optional and to design a plan that empowers the freedom to give, serve, and enjoy life like never before. And at Wise Wealth, again, we are known for education and simplicity because we believe that education should take someone from information, knowledge to transformation or wisdom. And we believe that by making the planning process simple, we can help avoid confusion and build confidence, again, through the Simplify Your Retirement Plan. Some of the common questions that I get a lot is, what if I want to work with you, but most or all of my investments are in my 401k? Well, if that sounds like you, that's fine. We work with a lot of people that are in those critical 15 years. So they might be still working and have many of their assets in their 401k. And I always tell people this is totally fine. We work with people who have the majority of their assets in their 401k. There's a lot of opportunities there that we can take advantage of and help you on the path to retirement. What if I already have a financial advisor or a CPA or a financial professional? I always tell people it's really good to get a second opinion. And we do this complimentary. We offer a free second opinion for people that are interested in some of the things that we talked about today. But especially like if you went to a heart doctor, there would be no concern about getting a second opinion for that. And a lot of times people don't do that when it comes to their finances and to their retirement plan. So I'd encourage you to schedule a call then too. Some people might say, what if now is not the right time? Well, I would encourage you, if you're in the critical 15, so 10 years before retirement or just retired, now is the right time to be planning for, especially a lot of these tax law changes that have happened recently and that will be expiring soon. Can I implement a financial or retirement plan on my own? And I always say, yes, it just might be a lot harder. So I would encourage you, if you have any questions, schedule a free call. We'll go over your current situation and figure out how we can help you. So with that, I just want to say thank you so much. Again, my name is David Sandu. I'm a financial advisor at Wise Wealth. All my contact information is up on the screen. If you want to schedule a call, I'd love to hear and learn more about you and how we can help you simplify your retirement. So with that, just want to say thanks again and hope you have an amazing day.